Every year, more retirees lose hundreds of dollars from their Social Security check to a hidden tax rule frozen since the 1980s, and most never see it coming. Here's the problem. The income levels that decide whether your benefit gets taxed haven't been updated in over 40 years. But your Social Security check keeps rising with cost of living adjustments, like the 2.8% raise that hit in January 2026. That raise is good news for your wallet, but it can also push you over an old frozen line and straight into the tax torpedo. Today, I'll walk you through exactly how this works, the one deadline that matters most, and the legal moves that can shrink or even erase the tax. Stick with me through the checklist at the end. Here's the deadline that actually matters for this tax. It's not Medicare's October enrollment window, it's December 31st. Any move you make to lower your taxable income for a given year, like a qualified charitable distribution or a Roth conversion, has to happen by December 31st of that year to count. There's a second deadline hiding behind the first. Medicare's IRMAA surcharge, the extra amount high earners pay for Part B and Part D, is based on your tax return from 2 years earlier. That means a large withdrawal or Roth conversion you make in 2026 can raise your Medicare premium in 2028. Both deadlines reward the same habit, planning your income before the calendar year closes, not after. Step 1. Know the formula the IRS actually uses. It's called combined income, sometimes provisional income. Here's the math. Take your adjusted gross income, add any non-taxable interest like municipal bond interest, and then add half of your yearly Social Security benefit. Whatever number you land on is compared against the thresholds we'll cover next. Notice what's included here. It's not just your pension or your IRA withdrawals. Tax-exempt interest counts too, even though you never pay income tax on it directly. That surprises a lot of people who assumed municipal bonds were a safe way to dodge this test entirely. They're not. Write this formula down, because every other step in this video builds on it. Step 2. Know your thresholds because they have not moved in decades. For single filers, they're $25,000 and $34,000. For married couples filing jointly, they're $32,000 and $44,000. The lower tier goes back to 1984. The upper tier goes back to 1993. Neither has ever been adjusted for inflation. Meanwhile, the 2.8% cost of living raise for 2026 pushed the average retired worker's monthly benefit from about $2,015 up to roughly $2,071. Even the cap on wages taxed for Social Security rose to $184,500 for workers in 2026. Almost everything in this system moves with inflation, except the two numbers that decide whether your benefit gets taxed. That mismatch is the entire tax torpedo. Step 3, and this is the misconception I hear most. An 85% taxable share does not mean an 85% tax rate. Below the lower threshold, none of your benefit is taxed. Between the lower and upper threshold, up to 50% of your benefit becomes taxable income. Above the upper threshold, up to 85% of your benefit becomes taxable income. That's the maximum share that gets added to your tax return, not the rate you pay on it. Once that portion is added in, it's taxed at your normal marginal rate, the same brackets as your wages or pension. So if you're in the 12% bracket, you pay 12% on that portion, not 85%. It's a real cost, but it's smaller than the scary number makes it sound. Step 4, stack your deductions because 2026 has a new one. Everyone gets the standard deduction, $16,100 single or $32,200 married. If you're 65 or older, you get an extra $2,050 single or $1,350 per qualifying spouse. On top of both, A new temporary deduction from the One Big Beautiful Bill Act gives filers 65 and up an extra $6,000, up to $12,000 for a married couple where both qualify, through 2028. Stack them together, and a single filer, 65 or older, can potentially shelter around $24,150 of income. But this deduction phases out starting at $75,000 in income for singles and $150,000 for couples, disappearing entirely at $175,000 and $250,000. And it's important, this doesn't change the Social Security thresholds themselves. It only lowers what you owe after. Step 5. Watch for the Medicare Cliff because it's a different trap tied to the same income numbers. In 2026, if your income is above $109,000 single or $218,000 joint, based on your tax return from 2 years earlier, you pay an IRMAA surcharge on top of your normal Medicare premium. The standard Part B premium is $202.90 a month in 2026, up from $185. But cross into IRMAA territory, and total Part B premiums can run from $284.10 up to $689.90 a month, plus a Part D surcharge of $14.50 to $91. Here's the trap. It's a cliff, not a slope. $1 over the line triggers the entire higher bracket. If your income drops later due to a life event, you can appeal using Form SSA 44 within 60 days of your notice. Step 6. If you're 70 and a half or older, put Qualified Charitable Distributions to work. A QCD lets you send money straight from your IRA to a qualified charity. That amount can satisfy your required minimum distribution for the year. But here's the key part. It never counts as income on your tax return. That means it never gets added to your combined income calculation, so it can't push more of your Social Security benefit into the taxable zone. For retirees who already give to charity or who are sitting on an RMD they don't need for living expenses, this is one of the cleanest ways to lower the number that drives this entire tax torpedo without changing your lifestyle at all. Step 7. Mind where your income comes from, not just how much. Remember, tax-exempt municipal bond interest still counts toward combined income, even though it's federally tax-free. So switching everything into munis won't dodge this test the way many retirees assume. Instead, think about withdrawal order and timing. Some retirees convert traditional IRA money to a Roth in lower income years before required minimum distributions begin, so future withdrawals don't add to combined income at all. Others draw from taxable accounts first to leave tax-advantaged buckets growing longer, because your best order depends on your own income, accounts, and filing status. This is exactly the kind of decision to bring to a licensed tax advisor before you act, especially since it can also affect Medicare premiums 2 years down the road. Let's put it all together into one checklist before you go. Know your combined income. AGI plus non-taxable interest plus half your Social Security benefit. Check it against the frozen thresholds, $25,000 and $34,000 single, $32,000 and $44,000 married. Remember, 85% is the taxable share, never the tax rate. Stack your 2026 deductions, including the new $6,000 senior deduction, before year end. Watch the IRMAA Cliff at $109,000 single or $218,000 joint, based on income from 2 years back. If you're 70 and a half or older, consider a QCD before December 31st. And review your withdrawal order with a licensed advisor, since Roth conversions and account choices shape both this year's tax bill and Medicare premiums 2 years from now.